my name is Lena Castanos, and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program, then I will introduce myself and give the word to our guest speaker, Rashard Todd, and his team. Rashard Todd is a business community manager at CNB City National Bank. He will introduce himself and then take us through a presentation on what lenders look for in your loan application. Feel free to ask any questions throughout the presentation in using the Q&A function, and we will be responding to them as we go. If we cannot answer any questions during this webinar, we are happy to address them through our one-on-one services or connect you to resources like Rashard and his team that can help. We will also be sharing recording and a copy of these presentation slides afterwards. So what is the Capital Pathways program? It is a program funded by the U.S. Treasury SSBCI initiative. It is sponsored by the Virginia Department of Small Business and Supplier Diversity and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then go to eligibility and services. Capital Pathways is a no-cost specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared self-select out of or fail applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Only half of requested amounts reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply for loans actually get their loans approved. So Capital Pathways creates a path for financial and legal readiness. Our program offers immersive hands-on group experiences paired with one-on-one support. Who is eligible? Very small businesses at any stage facing challenges accessing traditional financing. The services that we provide include a guided self-assessment and legal structure validation, financial skills and tools, and loan application readiness. What do we do in our assessment? We start with a self-assessment that pinpoints your business key gaps so we can connect you with the right tailored resources, either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through more basic legal questions, and we partner with a law firm which can help you for more complex topics related to business registrations, trademarks and contracts, and agreement reviews. We also offer financial webinars on topics like financial basics, financial statement preparations, and QuickBooks training. Another one of our offerings includes one-on-one individualized and tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender prep. We also have a partnership with CNB that provides one-on-one support for those looking for capital. And we also offer webinars on topics such as what lenders look for in loan applications, like today's webinar: interactive mock loan interviews and simple application analyses, and webinars on SBA loan options. And that is it. That is our program. If you are interested in getting started, you can reach out through our website, which we will link in the Q&A in the chat for everyone to see. Or you can reach out to my email, which we will also link in our in the chat for you to see. So now I will give it over for introductions. As mentioned before, my name is Lena Castanos and I am today's moderator. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both the program lead and one of the advisors, business advisors in the Capital Pathways program. Today's session will consist of a 60-minute presentation. Again, feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to them as we go, and we will leave some time in the end for questions as well. So if we cannot respond to them, feel free to book us for one-on-one advising at no cost to you, and we will be sharing recording and slides after this webinar. And now over to Rashard to introduce himself and his team if he wants, and tell us a little bit about his background and give us the presentation.
Thank you, Lena. Before I get started, I want to thank Lena over at the Virginia SBDC for allowing myself and my team to present today with you guys. So I'll let my team go first, give them their short intros, and I'll go last, and I'll get started.
Yeah, good morning. So my name is Jabari Grant. I am the business community manager for Los Angeles. Been with City National Bank now for 7 years. I have 28 years in small business and commercial lending, wealth management, and other services. We are so excited today to be here with the Virginia SBDC. We thank them so much for being gracious and allowing us this opportunity to share our expertise and hopefully answer some critical questions for you all. So we all look forward to Rashard Todd's presentation, and we're also inviting of all your questions. I'll be working the chat and assisting with questions after the presentation. But thank you all.
All right, thank you so much, Jabari. So my name is Courtney Davis, Business Community Manager. I'm a colleague of Rashard Todd. Of course, I'm located in New York. Really looking forward to Rashad's presentation today. And as Jabari said, we are here to support Rashad, but more importantly, here to support the small businesses that are on the line and making sure that we answer every single question that you have. So we are here, and we're looking forward to this event. So if you have any questions, don't be afraid, put it in the chat, or if you want to shoot it to us, then we'll definitely answer it as quickly as possible. Thanks again.
Hello, my name is Brian Grant. I'm actually the Vice President on our CRA Business Development and Outreach team for City National Bank. I'm part of the supporting cast here. And so whatever we can do to enhance or to improve any of our webinars, that's what I'm here for. And I'm 110% here to support Rashad Todd on his presentation to your business community. Thank you for having us.
And thank you, guys. And I'm last. So I'm Rashad Todd, Vice President and Business Community Manager with City National Bank. I do cover DC, Virginia, and Maryland. And again, I want to thank everybody in this webinar for spending time with us today. So my goal is very simple. I'm going to take you guys behind a commercial underwriting curtain so you know exactly what lenders look for, how to prepare your business for capital with confidence. By the end of this session, I'm going to pretty much explain to you the numbers that banks expect, when to seek financing, how to match the right loan to the right product, why cash management matters, how to build your business ecosystem that can advocate for yourself. And like Lena said earlier, if any questions do pop up, please put them in the chat. And towards the very end, we will get to those questions and let's get started. So right now, this is our roadmap. Again, first, what do banks look for? I will cover 2 lenses today that every underwriter uses, which is your story and your financial performance as a business. Second, when should you seek financing? I'm going to pretty much burst some myths that you should only borrow when you're in a pinch. Third, the financing purpose and its types. I'm going to pretty much pair again the right credit tool with the right job so you keep your balance sheet looking healthy. Fourth, what is cash management? We're going to pretty much connect your AR and your AP and to make those more efficient so we can turn real dollars in time. Finally, again, is your business ecosystem. I'm going to break down the team you need around you that can make capital access faster, easier, and more predictable. In my opinion, everything points back to one thing, and that is capital readiness. Preparation is the difference between a fast yes and a frustrating no. So, when a lender or underwriter is evaluating your business, they look through, again, 2 lenses or 2 windows, your story and your financial performance. I'm going to pretty much start with the story first. You want to tell your business banker or tell a lender, why did you start your business? What problem do you solve? What's your vision over the next year to 3 years to even 5 years? The more your business banker or the more your lender can advocate you for underwriting, it pretty much explains why there are any bumps in the road doesn't define your business future. Next is your management experience. What expertise do you have? What makes your leadership credible in your industry? Third, operations. Walk me through your money flow. How do you generate revenue? How do you invoice and collect? What are your biggest expenses? How long does it take you to get paid? Clear operations make it easy to size the right credit tool. Goals and objectives. You want to be clear. If you have plans to buy a vehicle in Q3, Q4, you have any tax saving strategies, if you want to purchase a building 2 years from now, they need to know what's coming. So they can pretty much be proactive and structure, again, the right tool for your business. Competitor intelligence. Are you able to articulate who else is serving your customer? How can you show you will win the market share in your industry? You need to be upfront with your lender so they can build a stronger case when they go back to underwriting and advocate for you. Now let's get into the number side. Banks like to use the 5 C's of credit, and that is character, capacity, capital, collateral, and conditions. Character is your entire personal background, including your personal credit. Some mistakes are missed payments, mixing personal and business cash flow, missing any tax filings. To fix that, you want to have separate accounts for both personal and business, have a clean background, and have your bills on auto pay so you don't miss any payments. Second would be capacity, and that is your ability to repay from your business cash flow, not just the sales. We look for a consistent coverage of annual debt payments. Some mistakes for that would be pretty much pointing to revenue, counting one-time wins, and ignoring any business seasonality. To fix that, you want to have at least 1 or 2 years of monthly P&L, be able to pretty much explain if your business have seasonality And if you have this product, use line of credit to bridge the timing. Capital is the owner's money at risk and his or her cash reserves. The common mistakes with that will be expecting 100% financing with no cushion. To fix that, again, show owners equity invested. You want to keep at least 3 to 4 months of fixed costs in cash. Collateral is any asset backing the loan product. It can be vehicles, it can be equipment, it can be real estate, it can be your AR. The mistakes with this can be if you're overvaluing your assets, no insurance, messy titles. To fix that, you want to have realistic values, clean titles, and insurance proof and maintenance. Lastly is conditions, and that's, sorry about that. I tried my laptop right fast. I do apologize. Conditions, lastly, conditions. You want to have net perimeter explains the industry trends, any customer concentration, the local economy, and the bank's appetite. A mistake would be having one big customer with no plan B, and you're heavy in one customer, meaning this one customer produces 10% of your company's sales. To fix that, have a good pipeline and steps towards any risk mitigants. Now, I'm going to jump back to personal credit and why it matters. Even for business loans, your personal credit matters a lot. It signals your character and your payment behavior. Majority, if not all, small business loans will use the personal owner as a personal guarantee. Any owners of that business, 20% or more of the company can be used as a personal guarantee. So all scores affect the approval and the rate. Here's an important note under capacity and capital. Banks just don't look at how much you own or how successful your business actually is. We look for a balance in your financial picture. For example, if too much of your wealth is tied up in one sector or in illiquid assets, it limits your flexibility and makes lenders more cautious. That's why personal liquidity matters. Cash and cash equivalents show the bank you can meet your obligations quickly without selling any assets. You can have 7 to 8 figures in assets. Without accessible liquidity, your profile looks riskier than someone that has less assets, but more cash on hand, excuse me. So the takeaway is, it's not only how much you own, it's about having the right mix of assets and liquidity. So you're both able to cover any challenges that come your way and opportunities. Another, I'll say, gold mine to understand or know, every bank has an appetite for an industry it leans into and ones it avoids. If your bank does not assign you a designated business banking relationship manager or doesn't lend in your sector or industry, please consider a bank that will. You deserve a partner who will advocate for you. I'm going to pretty much define
I think, is it just me or did Rashard cut off?
Uh-oh, looks like he's frozen.
Let's give him.
Give him 1 second.
Yeah.
But it sounded like, well, I'll kind of pick up or just elaborate on some of the things that Rashard was speaking about. He covered some really important topics, and he really outlined the importance of making sure that you have a business bank relationship manager. And one of the reasons we highlight that relationship and give it such importance is because it's really important that you have someone dedicated to your business that has listened to your story, that understands your goals, and that really is going to be a partner and an advocate for you and trying to make sure that your business is on track for your lending goals, for your finance goals, and for your plans to buy equipment or your growth plans or whatever you have in order for the year. I'll let Rashard pick up right there. Rashard, so where I was at was I was just really highlighting again the importance of a business bank relationship manager and the benefits that that relationship brings in building your small business ecosystem. So I'll go ahead and let you pick up where you left off.
Thanks, Jabbar. I appreciate that. I do apologize, guys. My laptop is gonna give me issues the last 2 days, and it just died on me. Let me get back to where I was. Also, slide 3 or slide 4?
You're right there.
Okay. Like Jabari said, yes, having a designated RM is pretty much for your business is essential. Look at your RM like your lawyer. The more he knows, the more he can advocate for you and your business towards the banks and the bank's underwriters. I'm gonna give you guys some balance sheet ratios that both the underwriter and the business banker use when he pretty much evaluates your financial statements. One of them is going to pretty much be your current ratio, and that is your current assets divided by your current liabilities. That will show if your company can cover its short-term obligations by using short-term assets. The second key one, and again, these are balance sheet ratios. The second key one is a quick ratio, and that is your cash plus your AR divided by your current liabilities. And again, that can show if your company can cover its short-term obligations without selling any assets and by using less liquid assets. Now, let's get into the financing types and its purpose. My apologies. Let's get the slide. Let's get into when and seek financing. My apologies. The best time to apply is when profits and cash flow are solid, when your books are clean, and you can show a clear use of funds. Pretty much apply for strength, not when you're in a crunch. And some real-time examples, and I'll break it down by industries. If you are a seasonal retailer, apply in July or August for a fall line of credit to buy inventory and draw on that line in October or November and pay it down to zero by January or December when you can use your sales to convert to cash. If you're a contractor buying for a new contract, before mobilizing, set that line of credit for payroll and materials, draw at the kickoff, and pay when your invoice is paid. If you are a professional service firm looking to add a rep or another employee, you can use a small line of credit to fund its first 5 to 6 months ramp-up period, but make sure you want to show at least 3 months of a plan of how that LLC can roll off and be paid back down to zero. If you're into real estate and you're buying an owner-occupied building, start by using an SBA 504, but you want to pretty much, I'll back up. If you are leasing a property and you want to pretty much purchase the building at first, start this process that's at least 5 to 6 months before your lease in to get better terms and avoid any rush. Now, again, the myth to avoid is if I don't need it, I'll wait. I can't apply because I have bad credit. No collateral, I won't get approved. SBA has options for all 3 of these, especially the collateral. You don't need collateral to apply for a lot of small business loans through the SBA. Now, working capital, and I'll discuss this and I'll get into another term. Working capital is the day-to-day fuel for your business. Again, it's the current assets minus the current liabilities. That's your cash, your AR, and your inventory minus your account payables, which is your AP, and any short-term debt. Liquidity is cash or any cash equivalents that you can tap into quickly without disrupting your business operations. Now I'm going to get into the financing types and its purpose. I'm going to explain a few terms. One, a term loan. A term loan is a fixed loan that's paid back over time, where each payment reduces both the principal and you pay interest. So by the time the term ends, the debt is gone. A line of credit, or what's known also as an LOC, is a revolving line you draw and repay. Many LOCs are interest only while you are using them. So the principal does not come down automatically. Another term we use is your DSCR. That stands for your debt service coverage ratio. It is your ability to make loan payments, and that is pretty much this broken down by your cash available for debt service divided by the total annual debt payments. All that means is for every dollar of annual payments, how many dollars of cash flow do your business produce? Most banks want to see a 1.25 times or better. Now, let's get into short-term financing and long-term financing. When we're talking about short-term financing, that covers anything you can pay back within inside 12 months or less. Things like payroll, inventory, equipment, materials, and any other operating costs. The right tools for this would be, again, line of credit or commercial credit card, because they are often revolving and they often have an interest only while in use. So they're meant to be paid down as cash come in to your business, like from your customers' invoice as your AR. Once you're using these products, many banks will also ask for a brief annual clean down. All that means is have the line go to zero before 12 months are up, so the banks can see that that actual product is being used for working capital and it's not a permanent need. For example, and I'll break down ways to use a short-term financing as well. If you have a seasonal inventory, you can use the revolving line of credit to draw for inventory, sell once you get your money back, and again, have that clean down to zero once the cash comes in. If you have any product costs, use line of credit for materials / payroll, doing a 3 months to 4 month job, and pay it down once your customers pay you. These are the right way to use small term financing products. Now, the wrong way to use this would be, say you're buying a 5-year or a 10-year asset on an interest only line of credit. Remember, that principal will still linger while that asset depreciates. As classic would be over leverage. Once you're over leveraged in the business world, you're considered, it's like a red flag. Now, I'm going to talk about long-term financing. Long-term financing covers assets that last beyond a year and more, like equipment, vehicles, any tenant improvements, or real estate. The terms or the tools used for this would be term loans or any SBA loans, which mean each payment reduces the principal and it also pays the interest. So the useful life of the asset and the long term should line up. So the debt declines as the asset depreciates. Now, here's some long-term ways to use it correctly. If you're going to buy equipment or vehicles, use that term loan or use an equipment financing loan that matches that product useful life. If you're going to have a tenant improvements or real estate, you can use a SBA 7A loan for the build outs and working capital. You can use SBA 504 to acquire the owner occupied property, or if it's IRE stands for investment as well. And a golden rule again, pretty much you want to match the repayment term to the life of the need. If it's a short-term need, make sure it's a short-term tool. If it's a long-term asset, use a long-term tool. Now I'm going to break down which products to use based off of what stage you are in business. If you're a startup or if you're are in that pre-revenue stage, a lot of times your capital will come from your owner's equity, any small grants, any micro loans, any small credit cards, or if you're able to get a line of credit, it will have that personal guarantor as well. If you're in the early stages, like your first 2 years of business, you want to target a small line of credit that is based off your AR or inventory if you have any. You know, you can invoice for larger jobs. Use equipment loans that are secured by the SBA 7A. Now, if you're in that mature or in that growth stage, if it's 2 years out, you will have a line of credit that's monitored by the bank, and again, more and longer terms for equipment. And then if you're in that mature stage or the exiting stage, you can get loans that are non-recourse. Cash management. Cash management is pretty much turning sales into cash faster and paying bills on purpose, with purpose. As your AR stands for your accounts receivable. It is the money your customers owe you. You want to make sure you want to bill the same day, use clear terms, and make it easy to get paid back. We'll talk about your AP, that is your accounts payable. That is the money you owe your vendors. Make sure you schedule your due date, not earlier by default. Use the bill pay with 2 approvers to control the timing and reduce any fraud that could happen. You can also try to negotiate your terms with the vendor where it makes sense, but you want to make sure that you also protect your vendor relationships. Again, cash management, some tools to make the cash flow smoother would be, again, your ACH, lockbox, remote deposit, any merchant services. Again, bill pay with dual approvals. You can use positive pay to stop that check and ACH fraud. And you can have your business banker utilities needs to match your workflow. Let's get into your business ecosystem. No one can scale alone. Excuse me. You want to design and build your team that can protect your growth and get your approvals accelerated. At the core, like Jabari, my colleague, mentioned earlier, myself, you want to have a business banking relationship manager. He's your partner who will learn all your personal and business goals. He can coach you on the capital readiness, and most importantly, he will be your advocate for your business with underwriters. Next would be a CPA or bookkeeper. You want to make sure you have somebody on your team that can keep accurate monthly financials like a P&L, a balance sheet, your AR and your AP aging. Remember, clean books are not just for taxes, they are your evidence for capacity. Next, you want to add some advisors like Lena at the Virginia SBDC or somebody with your local chamber. These partners can connect you with the proper resources and the proper somebody in that network, and they can pretty much be your advocate to move forward with your business. And most importantly, like I said earlier in this webinar, if your current institution does not provide you with a business banking RM, or if the bank doesn't lend or have a lending appetite that match your industry, please find a bank that work with you and advocate for you and be your partner. And any questions?
Looks like we don't have any questions, but I'd like to just cover over a few essential things just to drive some really important points home about some very fundamental or basic things that small business owners should know when preparing your business for credit. Rashard touched on them very nicely, but I just want to really highlight them because they're so important. There are a few things that we see in the small business sector that we see are common among small business applicants. And one is the notion that you don't need good personal credit if you've built up your corporation credit or your Dun& Bradstreet number. When it comes to getting bank financing, your personal credit report is going to be detrimental. It's going to be so important that you have a good personal credit profile because as Rashard was speaking about those 5 C's of credit, character is going to be one of those primary C's. And the only way a bank underwriter who's never met you before in their life is going to be able to determine what your financial character is, what your attitude is, or what your history is when it comes to paying debt that has been extended to you is through your personal credit report. So making sure that you're extremely transparent with your business bank relationship manager can give them an opportunity to help you put together a good package when presenting to a bank underwriter. So your personal credit history is going to be extremely important. Another very essential fundamental component of accessing capital, making sure you have good financial records in place is going to be so important to have a good bookkeeper and a good CPA. One of the 2 common missteps we see from business owners is not really understanding their financial picture because they haven't sat down with their bookkeeper or their CPA and have gone through in great detail their profit and loss statement and your balance sheet. So your profit and loss statement and your balance sheet tell the financial health of your business at a certain point in time. So if you have a December 31st, 2024 balance sheet, that balance sheet is going to tell the health of your business. It's going to say how much liquidity or cash you had on hand. It's going to show how much debt you have, and it's going to show the relationship between how much liquidity you have and how much debt you have. These are all going to be components that a bank considers when they underwrite you for your credit request. Now, who can help you determine what a good ratio is, what a bad ratio is, what it should look like? It's going to be your business bank relationship manager, which goes back to the importance of that relationship in your business ecosystem. And again, we want to express to all small business owners, it doesn't matter if you're $2 in gross sales a year, $50,000 in gross sales a year, or $5 million in gross sales a year. If your institution does not offer you the advocate and consultancy of a business bank relationship manager, please consider a financial institution who deems your business important enough to have one. It's going to be critical to your success. A good bank relationship manager is as important as having a legal representative or a CPA. And those are 2 very important components of small businesses that we've seen impact businesses in a good way or a bad way. For example, in a recent year, I believe it was 70% of the businesses who failed were profitable. I'll repeat that. 70% of the businesses that failed were profitable. Why did they go out of business? A lack of cash flow. If you don't have good, sound financial records and cannot readily determine your cash flow, it can choke, even though being profitable, it can choke the cash flow in the business as the business begins to expand because you can't acquire the capital that you need. But by maintaining good financial records, a good bank relationship manager, a good bookkeeper, and a bank relationship manager that converse with one another and consult you on a regular basis will make for a wonderful picture, and it will make life so much easier. You'll be able to go in banks commanding your presence and demanding and asking very planned out questions that are intentional and purposeful because you have a good understanding of where you are financially. And that's the empowerment your business banker should give you. And Rashard made a good comment. Think of your business bank relationship manager as your attorney. You tell them the good, the bad, and the ugly. That's why the word relationship is so important in that title. You should have a open communication and transparent relationship with that person so you can tell them everything, and together you help develop a story that is palatable to the underwriters. So I'll pause there for a second. I think Rashard, you have your hand up?
You have a question in the chat that's a great question. And I missed that in the webinar, and I apologize for that. Someone asked, if I'm filing for a loss the last few years, would that affect my loan application? That is a great question. A lot of business owners like to have a tax strategy where at the end of the year they want to, pay less taxes. But in the banking world, if you're going to acquire capital or take on debt from a bank, you have to have a positive net income and show some cash flow. If you're filing for a loss each year, in the bank's eyes, that's risky and it's pretty much cautious. We have a few more questions in the chat as well.
And hold on, Rashad, real quick. I would like to expand on that question too.
Of course.
I think, yeah, that's a great question. If you are showing losses year over year, there's two components I want to add to that. Well, one is let's dispel another misstep we see from small business owners who are actually profitable businesses, but they overstate their expenses to reduce their tax exposure. They don't want to pay taxes. Our best recommendation to small business owners is please do not do that. Do not do that. Because what happens is you may save thousands of dollars in taxes, but you miss out on tens of thousands of dollars in revenue because you can't get bank money because of your net loss that you're showing year over year. Now, let's say you naturally had a net loss through operating, just through your normal operations, you suffered a net loss, but you're turning it around mid-year. Let's say 2025, 2023, and 24 were losses. 25, we're really turning it around and we have a good future. Well, we can recommend other lenders that may be able to help you in the interim with maybe an SBA 7A loan where you can use projection-based financing and they can use where you project you're going to be either based on a contract or maybe a PO offering. So there are lenders that can assist you, but again, who is the best person to help you recommend you to a lender who can help you if you're in that space? It's going to be a business bank relationship manager. So once again, that ecosystem comes into play even when working with a company that has year over year net losses.
Thank you. There's a few more things in the chat. We have somebody else asking, does this apply for beginner businesses?
Yeah, I'll take that question. When it comes to bank financing, typically banks want to see a business in their mature portion of their life cycle, maybe 2 to 3 years after opening. So when it comes to companies that are less than 1 year, it's a very young company with not a lot of track record with respect to revenue generation. So when it comes to startups, there are a few options for startups. One would be venture capital money. Two would be private equity money. And three, there is possible in some CDFIs, which is a community development financial institution, right? And those lenders, some of them can help startups up to a certain dollar amount. So there are some lenders out there that can help new businesses in their formative portion of their life cycle. But again, how can you get that information? Well, again, that's going to have to come through an advocate. And those advocates are people like Lena at the SBDC. They come through people like Rashard Todd, who covers the DC market. So there are a host of resources that are available to you. And you have two very powerful advocates. I know Lena especially, that is here to assist you if you're in that stage of your business life cycle.
Thank you. It's a response to your previous statement of businesses fail. I'm sorry, you said at least 3/4 fail because they're not profitable. Is that because of poor spending, mixing personal and business, or any other reasoning?
Well, very excellent question. Man, I love these questions. So again, let me rephrase what I said. If I misspoke, I'm sorry. It was a couple years ago that it was 70% of the businesses that failed were profitable, not unprofitable. They were profitable. The reason they failed is because they lacked cash flow. So they were creating great revenue and they were making profit, but their business was growing faster than they could borrow money. And the reason why they couldn't borrow money is because they didn't have good financial records in place. That was the reason they failed. Now, some of the components you mentioned are also variables that can lead to a business closing their doors. You never want to commingle your funds. We strictly, from a tax perspective and from a lending perspective, it gets very messy and troublesome when you commingle your personal funds with your business funds. So absolutely keep those two segregated. One, it just helps for good, clean record keeping, and it will help your CPA be in a better position to help you implement a tax strategy. And by using this business ecosystem we keep speaking about, between your tax professional and your business bank professional, you'll find that median in between tax strategy, but still remaining bankable. You don't want to depend on your tax person to give you bank advice, and you don't want your banker giving you tax advice. But by using your business ecosystems for their respective professions, you'll get the best of both worlds and a great outcome if you can create synergy between all those two partners. But I hope that answered your question without going off topic. But yes, some of the things you mentioned do lend to business closing their doors, but the ones I was specifically speaking about had more to do with their lack of ability to access capital because of poor record keeping.
Thank you, Jabari. We have 2 more questions in the chat. This one goes pretty much, it says, how do you suggest we find a good bookkeeper? Does the banker usually do both? And the last question, do banks loan money for raw land for their business? I can
Okay,
answer the second one. The first one, I'll let Jabari answer that, one of my colleagues.
yeah, so for the most part, again, do not depend on a banker for tax advice. Don't do that. And if you're looking for a good bookkeeper, again, you can use resources like the SBDC. Lena and her team work with many business owners in the community, in your community, and know some of the best resources when it comes to tax professionals. Because here's the thing about tax professionals, just like banks, they have their own appetite also. Some tax professionals are great at manufacturers, some are great at law firms, some are great at medical professionals. So again, finding the right tax person for your industry is key. And again, using resources like the SBDC and others, and bankers, your banker works with a lot also, they should have several. And because we can't show preference to any one practitioner of taxes, we typically give you at least 3 to 5 that we work with so you can have an option to choose from, because they're not sponsored by the bank, nor do they have a relationship with the bank. And then Rashad, you can answer the second half of that question.
Yeah, so do banks loan money for raw land for a business? And there's one more question after that. But for this particular question, a lot of commercial banks tend to avoid raw land due to it not being as profitable and more risky. Now, not all, but majority does. And like Jabari said, it's other ways to acquire capital, like hard money loans, anyone that does private equity, anyone that does with Fannie Mae or Freddie Mac. You can pretty much find these through, again, your banking advisors like Lender from the SBDC to pretty much navigate and put you in the right lane to find someone that's an expert that can get you the raw land for your business. The next question is, I'm starting off a business. How can that affect my application? How can I ask for a loan to start up for my equipment? And do I have to show a plan, a business plan, and a business website?
Sure, I can take that question also. Again, if you're working with startups, your options are going to be limited when it comes to lending. However, there are lenders available, especially community development companies or CDCs, but also CDFIs that can help you acquire SBA 7A loans that can help you with startup capital. Typically, yes, you want to develop a strong business plan, not just for the loan, but for you also, because plans fail when there's no consultation. So making sure that you have a good plan in place to give you a good foundation and structure, and then you can demonstrate to the lender that you know the business that you're going into so well, and you're confident that the lender can also have confidence in lending you money even as a startup company. So yes, a strong business plan is recommended. Good projections are recommended, maybe based on industry information that you can find online, depending on the industry you want to go into. So you want to have a good forecast of revenue, what you think you may make based on market conditions and the equipment you want to acquire, and based on your experience and expertise. So those are 3 things you want to include in that business plan that will give the SBA confidence that you will be able to service the debt that you're requesting. Hope that answers your question also.
Thank you, Jabari. And there's one more question that's popped up. I'm a retired veteran. I'm trying to do a startup. Tell me the first place I should seek for help.
The first
Right.
place you should seek for help is Lena at the SBDC. I'll tell you that this firm is such a wonderful partner to have in your community. That's why they're here. They're the reason we're here right now. So that is the first stop I would make, and they will be able to assess where you are, assess what you know and what you don't know, because you don't know what you don't know, and then we'll be able to guide you with resources from there, resources and good partners from there. But that's the first place I would begin.
Sorry, Jabari, can I just reiterate something that came out during the presentation?
Sure. Yeah.
Yes, so thanks. One of the things that Rashad said was the best time to borrow is not when you need the money, but ahead of time. It's recommended, if possible, 3 to 6 months before you actually need that money. Because if you're at the bank and you're like, you squeezing the bank and saying to the bank, hey, I need this loan, my business is going to go down, then you really miss the boat. And so one of the fundamental things that we as lenders do know is that we want to ensure that you have the information so you can prepare yourself ahead of time. One of the things that you want to do, you want to arrange that particular facility way ahead of time. Just think about what would have happened recently, especially with the new tariff. For those businesses that actually had prearranged a facility ahead of time, they were able to, when that tariff came into effect, they were able to mitigate that type of risk because they have cash in hand, or they have a facility where they could arrange to pay the tariff. Now think about the person who never had that particular type of facility. What happened? That particular person is now struggling because now they have to go to the bank. They're not in a superior position, and your banker knows that. Your banker knows when you are graveling, you're trying to clutch at the straw, right? You don't want that. You want to be in a strong position where right now, you can make informed decisions. And it shows when you as a business owner come to us as a banker and you're able to say, I need this money and I'm going to need the line of credit in 6 months. It really gives us confidence that you know your numbers and you know what's happening in your business, and you know your industry. And that's fundamentally important. So just wanted to bring that out a little bit. I know, he spoke about it, but understanding and being ahead and thinking, way ahead of the need, it really gives you a strong position with your banker. But more importantly, it sets your business up for success.
Thank you, Courtney.
Awesome.
We have two. I love the questions in the chat. We have two more questions. In my business plan, should I reference that I manage a $5 million budget in my previous job? Yes, that goes back into the character. I'm sorry, to your character and your management experience. If your job is in the same realm of your business, that ties into your manager experience. What gives you the credible or the credibility for this industry?
Yeah, I
That's
would absolutely mention that. Yes,
Yeah.
that does lend to your credibility.
And it speaks about your story too, right? It's your story.
yes.
It's a part, you're painting a picture. It's a Picasso, right? So part of your story is what you have done and what you are able to bring to the fore, the skills that you have and that you've acquired ahead of time, and you're able to now display them while you're taking on this new role.
Absolutely. Let's get to one more question. It sounds like there was another question I want to make sure we get to.
It is. I think it's one more. Okay, we go. I use my personal and business credit cards to purchase my initial business cards and inventory because that's all I had at the moment. Will that cause a problem when I file my taxes? Also, I'm saving all the receipts. How how do you suggest I keep the records? Is there a good app to upload them?
Great question. Again, don't ask a banker to be your tax professional and don't get banking advice. Don't get banking advice from your tax person. This would be my recommendation to you. Find a good bookkeeper that can give you the best recommendation on how to allocate those monies. One, the personal money that you use for the business, likely you're going to treat that money as a loan to the company on the balance
Mhm.
sheet. It'll be a loan from shareholders. And if you ever want to acquire business debt that can repay that loan so you can separate the business and personal, you can do that later. But as far as the journal entries themselves, I would make sure you consult a bookkeeper or a CPA.
Thank you, Jabari. One last question that's popped up. It says, Jabari mentioned not to commingle personal funds with business funds. Going into my startup, I'm approved for the startup costs. Am I able to invest or inject a couple thousand of personal funds as cash on hand?
Well, again, you can inject cash into the business and you can, but again, work with your bookkeeper for the proper journal entries, but just make sure you don't commingle your personal account with the business account. So don't commingle the funds per se, but absolutely, you're going to have to inject personal capital into your business on a startup, especially if you're the primary investor investing in yourself. That's actually a good sign when banks see that, because that means you're putting capital and skin in the game into the business. So absolutely do that. But as far
Exactly.
as the journal entry, work with a bookkeeper. I'm
Thank
sorry,
you.
Lena. We went over just a little bit. I apologize.
I think we did. And this isn't a question, but he said not a question, but I want to say thank you for your presentation. It truly inspired us to aspire. This is way helpful. This is way above helpful for me, and thank you.
Thank you.
I
Thank you so
appreciate
much.
that.
Thank you.
Thank you. I would like to thank you all for attending and presenting, for the panelists for presenting, and for such a fruitful conversation. We will have some of these reoccurring webinars, and we encourage everyone here to rejoin if you want a refresher. Connect with us if you would like individualized support, and we can connect you to the CNB team as well. I would like to also, just before we finish off, there is an app, Genius Scan. It's a free app, and you can take a picture from your phone of a receipt. It automatically turns it into a professional PDF for you, and then you can save it in your iCloud or email it to yourself. And this way you can take physical receipts and save them in a electronic structure. So that's the one thing I would recommend here. But anyway, thank you all again, and have a great rest of your days.
Thank you all. Thank you, Lena.
Goodbye.
Oh,
Thank
one
you.
more question, guys. I do apologize. It came in last. It came in last. Can I get some support yes, you can reach out to Lena and she can schedule with myself and my team a one-on-one consult. Again, we do give out one-on-one consults here at CNB. It doesn't matter if you bank at Chase, Bank of America. The main goal and the main objective is to pretty much to assist the small business community. So again, give her an email, give her a phone call if you guys need any one-on-one support, and she will reach out to me or my team, and we'll go from there.
Check out the chat. That's all the information for individual support is there. All right. Thank you again. Have a good rest of your days.
Thank you, Lena.
Goodbye.